Good evening, and welcome to the Crypto Overnighter. I'm Nicodemus, and I will be your host as we take a look at the latest cryptocurrency news and analysis. So sit back, relax, and let's get started. And remember, none of this is financial advice. And it's 10 p.m. on a Wednesday, May 24th, 2023. And welcome back to the Crypto Overnighter, where we have no sponsors, no agenda, and no BS. But we have gotten so much closer to that 100 subscriber count on the YouTube channel since we started talking about the contest a couple of days ago. So if you haven't subscribed, give it a thought. Not only are you helping out the channel, but you're making sure you don't miss a single nightly update. So really, it's a win-win. Now, on to the news. The European Commission wants to ease regulations for commercial lenders regarding stablecoins and tokenized assets. This comes after lawmakers expressed concerns about crypto holdings and their impact on the banking system. In January, the European Parliament suggested that banks should be required to have €1 of capital for €1 of crypto that they hold. Now, it appears that the Commission's leaked document aims to moderate this position. The proposal suggests a 1,250% risk weight for crypto assets. This means lenders would need to meet a maximum capital requirement. However, stablecoins tied to non-fiat assets like gold would have a reduced risk weight of 250%. Tokenized assets and stablecoins based on fiat currencies would be treated as the same as the underlying asset. That is, unless there are additional credit or market risks. The proposals align with the forthcoming Markets in Crypto Assets regulation. Now, MiCA will regulate stablecoin issuers and mandate appropriate reserves. The Commission emphasized the need for a regulatory framework to address the risks associated with bank exposure to crypto assets, highlighting the potential threats to financial stability in individual banks. The plan also requires supervisors to ensure that banks manage cybersecurity risks, money laundering, and valuation issues associated with holding crypto assets. Bitcoin and Ether would still have a 1,250% risk weight. This, of course, is causing some concerns within the traditional finance sector. The Commission's plans have been seen as inhibiting deal-making and raising uncertainties. However, they are considered to be an improvement for tokenized assets and electronic money, addressing concerns raised by industry groups. Now, these proposals aim to align with the standards set by the International Basel Committee on Banking Supervision, and the Commission plans to finalize a more permanent strategy based on the global standards after 2023. These proposals must be negotiated with the EU member states and approved by the Council before becoming law. And speaking of regulators, let's move on to the Central African Republic. The International Monetary Fund has shown optimism toward the Central African Republic since it adopted Bitcoin a year ago. The IMF's surprisingly positive outlook reflects the country's economic prospects and the impact of embracing the leading cryptocurrency. In a published report, the IMF expresses a more positive view of the Central African Republic's economic prospects for 2023. This report predicts a rebound in the gross domestic product growth to 2.2%. Attributed to factors like the base effect and policy adjustments leading to improved fuel supply. The IMF also expects an average inflation rate of 6.3% for 2023. Now, according to this document, the Republic's projected public debt is expected to remain sustainable. However, the report does highlight significant liquidity risks due to relevant debt indicators. These risks stem from potential shortfalls in donor support and challenges in accessing domestic and regional markets. The Republic made history as the second country, following El Salvador, to adopt Bitcoin as a legal tender. Despite being one of the world's poorest nations, the Republic is leveraging the potential of Bitcoin to shape its financial infrastructure and enhance its economic prospects. After their approval of Bitcoin as legal tender, the government wasted no time in preparing to integrate digital currency. President Touadéra introduced the Sango Project, signifying the country's entry into the world of cryptocurrencies. In December of 2022, the Republic announced a delay in listing Sango Coin due to market conditions and marketing considerations. On March 31st, the organization behind Sango Coin reported additional delays, citing legal and regulatory obstacles. As of January 2023, the Sango Project disclosed that a government task force is actively working on legal amendments to facilitate the seamless integration of the cryptocurrency. Now from Africa, let's head over to Asia, where Japan is making waves. Japan is set to implement stricter anti-money laundering measures, including the travel rule, recommended by the Financial Action Task Force, and that's going to come up a lot tonight. Those measures go into effect on June 1st. At one point, the FATF deemed the country's current anti-money laundering efforts insufficient, so that's why the Japanese cabinet decided to implement the rule. The travel rule was proposed by the FATF in 2019. It aims to combat money laundering and terrorist financing involving cryptocurrencies. By June 2022, the FATF urged member countries to introduce legislation for the travel rule as soon as possible. And as we reported, the Group of Seven expressed support for the FATF's efforts to accelerate the global implementation of the travel rule. This rule mandates sharing information on cryptocurrency fund transfers between financial institutions. At the time of the G7 support, Japan had not yet implemented the travel rule. Japan's decision to implement the rule is seen as a move to align with global standards. And it's kind of a change because Japan and Japan's crypto industry have grappled with the travel rule since 2021. That's when Japan's Financial Services Agency requested virtual asset service providers to adopt the rule. In April 2022, the Japan Virtual Currency Exchange Association introduced self-regulatory rules in response to the travel rule. In October of the previous year, the Japanese government approved a cabinet decision to amend existing laws in order to curb money laundering involving cryptocurrencies, this time following FATF guidelines. Now, staying in Asia, let's move on to South Korea. A new bill is set to become law in South Korea within the next 2 months, requiring lawmakers and high-ranking government officials to disclose their cryptocurrency holdings. Seems pretty reasonable, actually. The floor leader of the ruling People Power Party is Representative Yoon Jae-ok, and he stated that the current scheduled date for implementing the new rules in December is just too slow. He emphasized the need for further revision of the bill and proposed adding a new clause to expedite the enforcement date before it goes to a vote. They highlighted the high level of public interest, particularly regarding lawmakers, and deemed it inappropriate to delay the enforcement of the law. This bill is expected to be voted on by May 26th. Currently, South Korean government officials are required to report assets such as stocks, bonds, jewelry, and gifted memberships that are valued at over 1 million Korean won, or around $760. However, there is no obligation to disclose cryptocurrency and digital asset holdings. Now, remember the travel rule? In March, that's when the country started enforcing the travel rule. But he sold that crypto before the rule was in force. Now, in response to the controversy, Kim resigned from the opposing Democratic Party on May 15th. On that same day, South Korean authorities raided the offices of 2 local cryptocurrency exchanges, Upbit and BitThumb. This was part of the ongoing investigations into Kim's alleged financial misconduct. Since the Terra ecosystem collapse in May of last year, South Korean officials have been fast-tracking cryptocurrency regulations and measures related to digital assets. Lawmakers introduced a comprehensive bill aimed at imposing stricter penalties for crypto-related crimes, including higher fines and prison sentences ranging from 1 year to life. Now let's take a look at a bit of controversy that Binance has gotten itself into. Binance has responded to a Reuters report that alleges that the crypto exchange mixed consumer funds with company revenue. Now, given what happened with FTX, that's a pretty serious accusation to be making. This information comes to us from unnamed former insiders. The report claims that the commingling of funds occurred frequently in accounts held by Binance at Silvergate Bank. However, Reuters did not find evidence that consumer funds were lost or stolen. Previously, Reuters found that Binance was able to access and transfer funds belonging to Binance US, also in a Silvergate account. Binance has not yet chosen to refute that claim. Binance has also faced allegations of mixing funds when it was revealed that the collateral for certain crypto assets was kept mistakenly in the same wallet as customer funds. You'd think people would know better by now. Former US regulators were cited in the Reuters report. They said the fund flows described indicated a lack of internal controls to ensure clear identification and segregation of customer funds. However, Binance's chief communications officer, Patrick Hillman, criticized the Reuters report. He called it weak and said that it was full of conspiracy theories. Now, let's be clear. So far, they have not outright denied the allegations. Hillman argued that Binance keeps user and corporate funds on separate ledgers and claimed to know the sources of the Reuters information. He also accused Reuters of xenophobia for mentioning the fact that CZ is Chinese, but not bringing up his Canadian citizenship. Hillman clarified that the funds in question were Binance's corporate funds from the sale of BUSD stablecoins, refuting Reuters' claims. Now from Binance, we move to the FATF, yes again. The Financial Action Task Force clarified that it does not mandate countries to impose a complete ban on virtual assets and virtual asset service providers. This statement came in response to reports that Pakistan's finance minister claims that the FATF had set such a condition for the country. Do what we say or it's going to go bad for you. Now, according to local news outlets, the Minister of State for Finance and Revenue for Pakistan, Aisha Pasha, said that the FATF's condition on not legalizing cryptocurrencies in Pakistan was necessary to avoid being placed on the gray list. Pasha reiterated her stance that cryptocurrencies would never be legalized in Pakistan during a session of the country's Senate Standing Committee on Finance. The gray list is a designation given to countries with strategic deficiencies in their efforts to combat money laundering and terrorist financing. Pakistan's government's position against cryptocurrencies was seen as a fresh ban. This despite the nation's troubled economy and political instability. Pasha reportedly instructed authorities to begin working on implementing a ban on cryptocurrencies. In January 2022, the Central Bank of Pakistan announced its intention to ban crypto, thus marking the first definitive stance on the matter. The FATF did say that they do require countries to assess the risks of money laundering and terrorist financing associated with the crypto sector. They're also expected to implement measures such as licensing or registering exchanges to regulate the industry, similar to other financial institutions. Virtual asset service providers must adhere to the same preventative measures as financial institutions. This includes customer due diligence, record keeping, reporting of suspicious transactions, and compliance with the FATF's travel rule. While the FATF declined to address Pasha's statements directly, it emphasized that countries have the discretion to prohibit virtual assets and virtual asset service providers, but are not obligated to do so. And finally, let's wrap up with some news from Coinbase. Coinbase responded to the US SEC in its ongoing lawsuit. They assert that their request for a response regarding new regulations for crypto assets is still valid. Coinbase criticized the SEC in a 23-page filing to the Third Circuit of the US Court of Appeals. They said that the agency is inconsistent in its statements and misguided in its actions. Coinbase initiated the lawsuit last month utilizing a writ of mandamus. This writ seeks court intervention in exceptional circumstances against federal officials. The objective is to obtain a specific response from the SEC regarding a prior request for new rules concerning digital assets. The primary point of contention revolves around the classification of digital assets as securities and the subsequent application of SEC trading regulations. The SEC informed the court earlier this month that Coinbase's recent legal action is unfounded. They said that they still require additional time to evaluate the original request. Coinbase reiterates its position that the SEC already made a definitive decision to reject their request for new regulations. They point to public statements made by SEC Chair Gary Gensler. Now, according to Coinbase, those statements leave no doubt about the agency's intentions. Coinbase argues that the SEC has no plans to engage in rulemaking concerning this matter in the foreseeable future. That is, unless the court grants their petition. Furthermore, Coinbase accuses the SEC of disregarding other petitions from the cryptocurrency industry for an extended period. They claim that the SEC's enforcement actions, including a recent Wells notice sent to Coinbase, demonstrate the agency's lack of consideration for their petition. Coinbase suggests that these actions indicate the SEC's belief that the current security laws adequately apply to digital assets and render additional rulemaking unnecessary. And that's going to do it for us tonight. If you enjoyed tonight's show, then please like, follow, subscribe, leave a rating, or maybe a review. And in the meantime, we'll see you tomorrow night.